Hi, welcome to Slay the Spider. I'm Jim B., the creator and host of Slay the Spider. Shares of the S&P 500 are called S&P Depository Receipts, SPDRs. Spiders. Slay the Spider means I intend to beat the S&P 500 quite substantially. This is the executive summary of this week's Slay the Spider snapshot. 2 weeks ago, we had 9 mini sectors on the bullish side and 31 on the bear side of the circle. Today, it's an even split, 20-20. The overall market indicator is still on the bear side, and I must admit the strength on the 2 o'clock rally kind of surprised me given the appearance of strength in the Dow and the S&P 500 these last 2 weeks. But what is. I made several changes to the Slay of the Spider circle this past week. The center circle is much larger. I did this to enlarge the date so that it could be seen on thumbnails and on smaller images I have planned for in the future when I add some new features I'm working on now. I think you're going to like what I've planned. Second, I've added a number in yellow in the center circle. This number represents the location of the overall market position, the arrow. 3. I changed the layout slightly to enable more room for sectors when they gather at the top and bottom in the red zone and the green zone. And fourth, I made the sector boxes a little smaller so that 4 boxes fit in between the grid lines, which are 10% apart. This may or may not stay. This also enabled me to lengthen the boxes so that I can have more than just 4 or 5 letters to identify the sector represented. I like using 3 if viewing on a phone because it's easier to use. I don't like that it takes up so much space when we are at the tops and the bottoms. I may even go back to 3 boxes in the 10% range, except when the red and green zones appear. We'll have to see how this works out in the future. This is a point and figure chart of the percentage of stocks on NASDAQ since 1998. The percent positive trend, OTC, was at its second highest level in 20 years in January. When it reversed down in February, NASDAQ declined over 10.5%. That's what happens when the percent positive trends declines. This is the point and figure chart of the percentage of stocks on the S&P 500 since 2000. NASDAQ Dorsey Wright and Associates noted this week that the S&P 500 percentage of stocks in a positive trend channel is at an all-time high since they started recording this in 1987, 34 years ago. It's at 91.29% right now. Over the past 12 months, the Dow is up 41%, the S&P is up 48%, and NASDAQ is up over 69%. So this positive trend being at a record is not really a huge surprise. On all the previous times the positive trend has crossed 90%, not once has it stayed there for over a month. The positive trend chart has exceeded 88% 4 times since 2000, not including this last surge. These occurred in April 2010, February 2011, May 2013, and January of this year, and now again this week. Here's a chart of the S&P and the Dow over the range of the first 3 times in 2010, 2011, and 2013. After the April 2010 positive trend peak, the S&P declined 16%. After the February 2011 positive trend peak, the S&P declined 16.3%. After the May 2013 positive trend peak, the S&P declined just 4.5%. After the January 2021 peak, the S&P declined 4.5%, while the NASDAQ declined 10.5%. The old Wall Street adage is sell in May and go away. Well, May is less than 3 weeks away. All we're waiting on now is the trigger. Will it be the border crisis, Perhaps the tax bill? Maybe as simple as sell in May and go away. Or something else we haven't even thought about. Russia's been massing troops and armored divisions on the border of Ukraine to invade the Donbass. It appears they're just waiting for the weather to clear and then they'll be moving in. China might make a move on Taiwan. What if Russia made a move and China used that as an opportunity to go, or vice versa? The market's currently trading at a PE of 42, which is only the third time in history it's traded over 30. If Russia and China made those moves, this market would be down 40% in a week. I do not like sounding negative, however, it is my obligation and duty to try and protect my subscribers from harming the markets. That's what Slay the Spider is all about. Paid subscriptions are now available. They're $15 a month on a month-to-month basis. It's $144 annually, which is $12 a month. There's still a 90-day free trial available, and there's no credit card required for the free trial. Watch my Slay the Spider video weekly. It's free. See the market tops and bottoms form, learn when stocks are about to go parabolic, watch it happen. Follow the playbook on my blog for what actions you should be taking now and practicing. There are lots of opportunities and plenty of risks to avoid as we move around the circle. I realize it's rather boring to watch weekly until it really makes a difference in your results. That's exciting. See you next week.